It's a great honor for us to host Hans Timmer, who is the chief economist for the ECA region. So ECA stands for Europe and Central Asia. So I don't know which part we are. We may be Europe, we may be Central Asia, but we are definitely ECA. And Hans, I looked at his vita before the meeting. He is a quantitative economist, so he works a lot with data. He is from Holland originally, from an institute where you worked, which was called Central Planning Institute.
Central Planning Bureau. Yeah.
Central Planning Bureau. I can tell you that this building, before it became ISET, used to be the Economic Planning Bureau of Georgia. But when the Soviet system collapsed and they were not planning anymore, so this place was used to, you know what they did for a living? They were selling doctoral degrees, and the price was $3,000. So if you had $3,000 and you want to have doctor in front of your name, you came here and you paid $3,000 and you got it. And then we came a bit later and started doing proper education and proper research, and that's it. Well, Hans, the floor is yours. The times, they are changing. It's a line from Bob Dylan?
Yeah.
Okay. Thank you.
Thank you so much. I will try to shout also. That's easier. Very nice to be back in Georgia. And actually very nice to be back in this school, because I've been here a couple of years ago. And I must say, of all the meetings that I'm having here, and it's a pretty intense program, this is the one that I'm always looking forward to. Because when you are at a school like this, at the university, that's the moment that you actually learn something much more than many of the other meetings. But also it's nice to look at what the bright future of the countries is, and that impression you always get at the schools. Indeed, the times, they are changing. It's Bob Dylan. It shows a little bit my age. He wrote that song in 1963.
I was born then.
I see. It shows our age. But it's also, I think, a good title for the current economic situation, and I will try to show that. But let's see whether this will work. Was the 1960s, a protest movement, the young people, but it was actually not a protest song. It was much more a wake-up call. He was telling the parents, the teachers, the journalists, the politicians that they have to wake up, because the world has changed. They cannot continue the way they lived their life previously. And so he described in that song, and you just saw that and heard it, that the water was rising, and then he sings that then you better start swimming or you sink like a stone. And later on there are the lines, for he that gets hurt will be he who has stalled. You have to start adjusting to the new situation. And I think that's a very appropriate viewpoint when you look at the current economic situation, because we need a wake-up call also, because indeed the world economy has moved on. We had all over the world till the global financial crisis, and for some countries a couple of years after that, a booming growth period. But these sources of growth that fueled that global boom, they have dried up. And you cannot go back there. And you have to realize that. And the big challenge now for governments, for firms, for households, is to find, embrace and unleash new sources of growth. So how do you go from here if you cannot go back to the past? And then what I'm telling when I'm interacting with the ministers and with governments all the time, that there is not really a unique set of policies. It is not that we have a toolkit And whatever the country is, whatever the circumstances are, if you do that, doing business indicators or what have you, then everything will be fine. Because we have seen countries grow very fast that actually did not have these kind of very specific policy recommendations. Just think about China growing 10% a year for 30 years, and there were policies that we would not recommend in another countries. Korea is another example. But what these countries that are successful for a very long period, what they all have in common is that they change when they need to change. When the circumstances change, when they reach a new level of development, where you need new governance, then they are willing to let the past go and actually adopt. And that is what is very much needed at the moment. So let's look at a little bit of data, because I think we are in a very special situation at the moment. So 3 cases. First, GDP growth numbers of Armenia, and I could take any other country here in the region, I could take the European Union, I could take GDP growth of many other countries also, but here you see the problem. So we had the boom period in the 2000s, a very high growth year after year, whatever you did, everything was wonderful. Then you had the global financial crisis at the end of 2008, negative growth all over the world, in many countries at least. And then you have a recovery, but everybody is surprised. There's a new normal, yeah? Growth is not going back to where that was. And that is something that is not completely unique. It is not true if you just have a cyclical downturn, but if you have a global crisis after a really exceptional boom, then it's very likely that you're not recovering back to those growth rates. So if you go 40 years back, and so we take the 1960s, the time that song was written, then we see here for the European Union, but again I could take many other examples. It was really a booming period, very high growth. It was the end of the reconstruction in many parts of the world. But if you look at Latin America, it was very high growth also there. And it was a period where there was a lot of coordination in economies, a lot of planning. In the Netherlands, the Central Planning Bureau. You had in Latin America, you had the import substitution. There was not a lot of trade, because after the Second World War it was very difficult to have these international connections. There was hardly any capital flow across borders. It was very inward looking. Of course you had lots of countries where you had really the central planning system, very inward looking. And then you had the oil crisis in the beginning of the 70s, and that triggered the big change. But actually you could argue that this period was running out of steam anyhow, and at some point you have a trigger, and then you realize that you cannot go back there, and it stops. And so you had a second oil crisis also, but on average the story is that you had very low growth in the 70s and the 80s. For example, in Western Europe, they first saw it as a cyclical slowdown. There's a lack of demand because all the money is going to the oil exporters and they are not spending it. So they tried to sit it out. They supported old companies. There was a lot of shipbuilding in Europe. They supported it. But at the end of the 80s, they realized that anyhow the world had changed because Korea had taken it all over, and you were no longer competitive, and you had to do something else. I don't know whether that's an accident or not, a coincidence, but we can go again 40 years earlier, and then we are in the roaring 20s. Again, a period of a lot of optimism, people becoming very rich because they were investing in stock markets with leveraged money. It's very difficult to get GDP growth numbers from that time. GDP growth was very volatile also, I'll come to that in a moment. But then you had the Great Depression, 4 years in a row of negative growth. This is the example of the United States, and on average the 30s had much lower growth than the 20s, and lots of awful things started happening in the 30s, and people had to rethink again where to go. Now that sounds a little bit dramatic, these big examples, but I really believe that we are in a time like that, and that has all kinds of important consequences. And when you start thinking about finding new sources of growth, redoing things that you, rethinking things, then you can get it right and you can get it wrong. And this is an example where they got it wrong. So this is GDP growth in Japan. Fascinating growth in the 50s and the 60s. They become the industrial powerhouse of the world, what China is now. Very successful in conquering the world markets, but basically growing in the industry sector. At some point that dries up, because at some point you have almost all the markets. You have closed the gap with the technological frontier, and then it's much more difficult to move that frontier. And so increasingly in Japan there were a lot of savings. Instead of investing it productively, they started investing it in existing real estate, and then at the end of the 80s that led to a big financial crisis, banking crisis, and then again you had another step down and very low growth. And clearly Japan was a country that did not find a new source of growth. And you can argue it was there, but they didn't want to find it. Because if you look at their service sector, productivity was very low. It was a very closed sector. A lot of protection of small services. And on average, the technology level or the productivity level in the service sector was only 50% of what it was in the United States. So if they had it opened up, then more investment would come in and you would have another source of growth, but for political reasons they didn't want to do that. And whatever they tried with fiscal stimulus, they couldn't go back to that old period. But then another example where I think you can get it right, and here we are looking, we continue to look at GDP numbers, GDP growth starting in the 60s, structural growth rates for high-income countries, and then for the rest of the world, the low and middle-income countries. And again, you see the very high growth in the 60s that then came down was really, like it is at the moment, a global phenomenon. Suddenly very low growth. But then you see at the end of the 80s, beginning of the 90s, something changed in the developing world. They started changing their policies. And so across the developing world, you start seeing that they were opening their borders. They were starting reducing the tariffs. They allowed financial flows to come in. And linked to that, because that's the only way you can do that, they started changing their macroeconomic policies, independent central banks, in the 90s even in most of the African countries, independent central banks, and that all resulted in not only high but accelerating growth all over the developing world, not because the whole world was growing, but because they found a new way of starting growing. Now, you will not grow forever, and the circumstances will change again, but it shows that if you have a forward-looking policy and you start thinking how can we do things differently, then you might be successful. So the observation is that after such a big global crisis, the world is never the same again. And you shouldn't think too long about the past. So let's think about the Great Depression, the 1930s. After that, the role of the government in the economy all over the world has completely changed. And it's largely because of Keynes. It's a Keynesian revolution. But in the 20s, in most countries, the expenditure of the government as percent of total expenditure in economies was probably 5–6%. It was very low. And now it's pretty normal to have 30–35% of all the spending coming from the government. It leads to much more stable developments that you had before, and everybody accepts it, that that's how you should organize an economy, and there's a lot of thinking about how the government can be efficient, the quality of service delivery, but nobody questions that you should go back to the 20s with a completely different role of the government. So what happened after the 70s, after the global, after the oil crisis, you came out of a period where countries were very successful with inward-looking policy, a lot of coordination, that very much fitted that idea of reconstruction also. But then they realized that somehow they had reached their end. And so all the countries all over the world, they started thinking about a more prominent role of market signals. Not so much by pushing back the government, but by making sure that the market starts playing a bigger role, not only internally in your own country, but also across borders. And that is the start of another wave of globalization. And this was the Keynesian revolution. You can argue that perhaps this was the Washington consensus. The idea that if you just leave it up to the markets, then everything will go well. And for developing countries, that really paid off, you can argue. So now we are where we are. Again, a period where we reach the end of the road a little bit. And I have no idea what a new world will be, but it will be a new world. And I just put here some ideas, but increasingly you see that there is more and more concerns about inequality within countries, global inequality, and that is becoming a problem for how economies are functioning. It is becoming a political economy problem also. Just look at elections all over the world. But then you see what you often see in the other periods also. You see also that the technology suddenly is changing, and countries have to adjust to that. You don't have to adjust when you are all in a boom period, and whatever you do, you start growing. But then when you have to grow without your tailwinds, then you have to start thinking about those new technologies. And one of the new phenomena is what we call the sharing economy, the Ubers, the fact that everybody can become more or less his or her own boss, which creates enormous challenges. You have to rethink a social contract in societies. And what you see now in many countries is basically that governments are fighting it because they have regulations that fitted very well the old situation, and that they try to protect it. But the countries that will be really successful is the countries that are not bracing for what is happening, but are embracing those new developments, not just by letting it go, but start thinking of how do you organize an economy and a society if the world is growing like this. That's a very big picture, but there's a little bit more happening than that, especially relevant for this region. The timing is not exactly as the timing of the global financial crisis, but it creates a similar kind of phenomenon, and that is the fall in the oil prices, which is also a very long-term, big super cycle, and the countries here in the region, not only the oil producers, but the countries that are indirectly benefiting from that, they had a huge boom because of the rising oil prices, and now suddenly that is over. And the point is that that negative impact of the collapse in energy prices is much more pervasive has many more consequences than people and also ministers realize what it does to your economy if these relative prices are changing. But in the same way, it also creates opportunities if you are forward-looking and if you are not defensive, because now suddenly with lower energy prices, you have an opportunity to diversify. Now you're becoming competitive in sectors that you were not competitive in because of the high oil prices. It's true for the oil exporters, but I will show it is even true for, so it's true for Azerbaijan, but it's actually also true for Armenia and Georgia. So a couple of examples for the oil exporters of how big the impact is. We look all the time, and everybody looks all the time at GDP numbers, and that's helpful. I will argue that to understand the impact of the falling oil prices, GDP numbers are actually not the right measure. But okay, also GDP shows that the hit is pretty big. Recession in Russia, much lower growth in Azerbaijan and Kazakhstan. 2015, very low growth compared to 2013. That's exactly the period that the oil prices declined. But this is the real story, because this adds to the GDP growth the terms of trade gains. The fact that your real income is changing in a way different from GDP, because even if you produce the same, what you can buy is less, because you get in the international market less money for it, and your import prices are still the same. So in real terms, your income is declining a lot more. That's what we call terms of trade gains or losses. There were still terms of trade gains in 2013, so you could add that to GDP growth. Countries, oil exporters were getting richer all the time. But then look at what happened in 2015, and it actually continues this year. I think I have a slide that shows that also. So look at Azerbaijan. A decline in income in 1 year of 15%. That comes after a decline, no, probably because you have to add them up. No growth in real income in 2014, and we will show that there is an additional decline in real income in 2016. A decline of real income of 15%. That's big. That is way bigger than countries experienced in 2009 after the global financial crisis. It has all kinds of consequences. So here we see Azerbaijan. Another decline expected in 2016, where we expect a decline in GDP now as a consequence of all these movements. But when we are looking at the price development, another decline. So if you add this up, then Azerbaijan in 2 years loses a quarter of its real income. And somebody has to take that burden in Azerbaijan. And that will be the big challenge for the policymakers on how do you absorb this kind of. But then we go to Armenia and Georgia in 2015, and again this is GDP growth. So if we only look at GDP growth, okay, it's not as good as it used to be, but it's still positive. But then if you add another phenomenon, and that is the change in the purchasing power of remittances coming into a country, and you add it up, you have also a measure of real income, and then you see that in Armenia, real income has declined also already, and that you have a very negative impact in Georgia of that also. And that is because these remittances are coming from countries, the oil exporters, where the currency is depreciating, and so you get that. We normally look at remittances in dollars. That's not really the right measure, but if you deflate it, and the most logical deflator for that is the import price, then you see that it is a big hit for other countries also. So, university, we need equations, And I'm from the Netherlands, so we have to talk about Dutch disease. Somebody knows where that's coming from, Dutch disease?
Everybody knows.
The 1970s, yeah? This was a term coined by the Economist because of the problem in the Netherlands when they had discovered gas and the gas prices started rising. We lost competitiveness in other sectors. So a very simple model. Suppose you produce domestic goods for your domestic markets, and that production is basically given, that is your production capacity. You're producing also energy, which you export, but also more or less given. Then you create income, that's the sum of this, that's the volumes times the price of domestic goods and the energy price determined in the global markets. And then you have a very simple demand function for imports. You want to spend a fixed amount of your income on imports, and we take the price of imports as numeraire in this system. That is one. Simpler than that you cannot get. And then you say, okay, in equilibrium, you need equilibrium on your current account, because you cannot continue borrowing or you cannot continue accumulating reserves. So the value of the imports equals the value of your exports, which in this very simple case is the value of your energy exports, your oil revenues. So if you take these two equations, then you get this equation. And if your production capacity to produce products for the domestic markets is more or less given, and if your capacity, the volume that you can produce of oil or gas, is also more or less given, then there is a one-on-one relationship between the price of your domestic goods and the price of energy that is determined in the international markets. Now, we use a little bit more complicated models than that, and then it becomes all more complicated, but this is the basic idea. That if energy prices are going up and you're exporting energy, then everything in your domestic economy relative to the international prices is becoming more expensive. Which means that if you would export something else also, you cannot export it anymore because you have become a lot more expensive than the countries that are not exporting energy. And it actually works in reality. And so what we are doing here is we look at the price of domestic products in Russia relative to an international price. And we take the price of domestic products in the United States for that. And so the solid line is what actually happened over the last decade and a half. And so there you see that in the period that oil prices started rising and Russia was exporting oil, that relative price, if you start here, doubled. Everything became twice as expensive as in the United States. If you start here, even more than that. And so we thought, wow, very close to what you predict with simple models. So let's just do a very simple econometric exercise. We try to explain this relative price only from one other factor, and that is the relative price of oil. Oil price in international markets relative to the price in the United States. And then you see that reality really follows what that very simple model predicts. And then you had a brief period of the global crisis, but then the oil prices started rising again, so not completely it was following, but then again. And here we are forecasting out of sample for a little bit more than the last year, and it's almost a perfect fit again. That's pretty surprising. It's especially surprising when you follow the headlines in the AFT and you discuss it with governments, because then you saw this big fall and then everybody says, oh, but that is overshooting and financial markets you can never trust and we have a problem at our hands. And then you see that was somewhere in 2014 or the beginning of 2015, you saw the ruble strengthening again, and this relative price as a result of that also strengthening again. And everybody says, you see, it was overshooting and it's coming back, and let's not be that dramatic. But it was exactly the period that the oil prices are strengthening again. And then oil prices fell and there was a depreciation of the ruble, and then it goes up again. And the lari here came up recently also. There might be all kinds of reasons why people have more trust in the lari, but it coincides with the rise in the oil price, the rise in the oil price, and we are getting there. But let's stay a little bit more with this Russian case. And there you see how difficult the situation is. So this is again what actually happened, that red line. That's basically the same line that we were looking at. So it's a real appreciation in the beginning. And a real appreciation you can achieve in two ways. You can have a nominal appreciation of your currency, and then you have that. But you can also have a stable currency, and you can have just more inflation in your own country than in the United States or the rest of the world, and the result is the same, and it doesn't matter a lot. It will happen anyhow, because these are market forces one way or the other. And so here you see that in this boom period, most came from the yellow part, and that is the relative inflation. Only at the end of the boom, there was, in addition to that, also an appreciation of the ruble. But then, in the downturn of the oil prices, you don't have a lot of choices. You have really a problem at your hand, because first of all, it comes very quickly. That's always true. When you have a bubble, it comes slowly. When you have a burst, and it comes quickly. But you can't really achieve it with deflation. That's not how the economy works. And if you want to achieve it through deflation, if you want to defend the exchange rate, then you really have a big recession at your hand, because that's the only way that these domestic prices will actually come down. And actually the argument is that countries that try to prevent that exchange rate, because they think that is financial stability, through all kinds of other mechanisms, they will get that deep recession. Because these are market forces. That is not something that you can avoid. One way or the other, these relative prices will start adjusting. And so that's where you see that decision to start floating the ruble relatively early on compared to the other countries, and they had a target of starting to float it, but they brought it forward. That was a smart decision, because they could actually achieve it now, that relative price change, with a depreciation of the ruble. And as a result of that, you see adjustments in the Russian economy that are much more advanced than in other countries. It's painful. You saw that in 2015 you had some decline in GDP, you had a decline of 10% in consumption, you had a decline of 30%, 30, in imports in Russia. That's all very painful, and you have to start thinking about that, because it's about sharing the burden. But it is an adjustment that ultimately will give you the opportunity to start growing in a new way, and that is because of the depreciation. Now this is again how striking this all is. This is monthly numbers for the nominal ruble and then the Brent price, and you see how closely it is following. I'm not investing in market, but if you want to invest in currencies, this is the mechanism. And
But
even
it used to be a lag, and now there's not even a lag.
yeah, there's not even a lag. And why is there not a lag? Because these are daily numbers. And even with the daily fluctuations, you see the correlation. And so there are investors that are understanding this mechanism. You have to assume. One other consequence. I'm using way too much time because I have still 200 slides, but at some point you just stop me. But I actually find this fascinating stuff because this is something when I did it, I didn't realize what was happening here. So we are looking now at the oil price relative to your domestic prices. And then you see that's the black line for Russia over that whole period was pretty stable, exactly like that small model predicted. So for people in Russia, there was never an oil price boom. Oil prices never went up because all prices went up, including the oil price. And so the only thing that happened in Russia, that imports became dirt cheap. That was the view. It was incredibly easy to start traveling abroad. And foreigners that would come to Moscow, and I've done that a couple of times, was completely unaffordable. It was not unaffordable when you lived in Moscow because everything went up. But not the oil price. And so we often write these stories also that oil producing countries, they are not energy efficient, and we often blame the subsidies for that. And it's true, they're often on top of that subsidies also. But because of this mechanism, you wouldn't expect oil exporting countries to be very energy efficient because there is no price signal to get that. Very different for Japan, a complete oil importer. For them, the oil prices went through the roof, yeah. And there you see all the reactions on the demand side also. And for them, you have the big advantage of the declining oil prices. So it has all kinds of consequences. It is not just revenues and then we have a fiscal problem. The whole structure of the economy is changing and all kinds of relative prices are changing. So let's leave Russia and go to Kazakhstan. And we will come to Azerbaijan and then we will come to Armenia and Georgia. So we do the same exercise for Kazakhstan. And again, basically the same picture, especially moving up, because you can do that with inflation also. You cannot prevent it, that's the Dutch disease. Also in Kazakhstan, the prices basically doubled and Kazakhstan was no longer competitive outside of the oil sector. And then they tried to prevent it, but they couldn't completely during the global financial crisis. And then here, they really tried to prevent it. And so they had a policy of keeping the nominal currency constant. And ultimately, you will lose that. And it backfires and it's incredibly costly. Because, first of all, you use a lot of reserves. So you're losing that. That's basically wasted if you are doing that. And then you have big fiscal problems, which you can solve if you have a depreciation, because now the full weight of the adjustment is coming on the fiscal side, while not all the revenues have come on the fiscal side, because actually everybody benefited from that, because for everybody in Kazakhstan the imports became very cheap. And then it's very costly because you don't create that incentive to start becoming more competitive in new sectors where ultimately the solution is. So, not a surprise, at some point they have to give that up in policy. And then they give it up again. And what is interesting, this is out of sample forecasts, is that nominal exchange rate that is being created, and where everybody says, we don't know, but financial markets, they are volatile, and it's probably overshooting, and it creates huge political problems, because everybody blames the government or the central bank for what is happening here. They don't have it under control. The relative price that is being created is exactly what the model predicts. That's pretty surprising. Azerbaijan. I thought I was talking about Azerbaijan. I was talking about Kazakhstan, Azerbaijan, basically the same picture, even more extreme. And again, you end up where the market says you have to end up. We use a lot of general equilibrium models for this kind of analysis, not only econometrics. And that's the story. You cannot fight it. You cannot fight it. But then it spreads to other countries. And there are many mechanisms through which it spreads, but it spreads to Armenia, it spreads to Georgia, and this is one of the mechanisms. That's the remittances coming from the oil exporting countries, which are actually pretty significant as percent of GDP, larger than the Philippines. And with these remittances, with workers working in an oil exporting country, you basically become part of that economy. And the adjustment mechanisms are becoming very, very similar to that economy. And so, surprise, when you start estimating a relationship like this, then you see also for Armenia that close relationship with the oil price. And now in Armenia you see a problem, yeah? There's a lot of arguments in Armenia against depreciation, but I don't think it's sustainable. Because one way or the other, this will come back. Now you might hope that the oil price will continue to rise and you don't have to bother anymore, but if not, then you have a problem. And Georgia less so. There was more depreciation here. It was not a popular thing, but also you can argue it's still hanging a little bit above where it should be. And this was the story that I discussed yesterday with the new governor of the central bank. The recent appreciation that can be trusted, but it coincides with what the oil price model predicts. So, okay, let's take stock a little bit. We had the 40-year cycle of the big crises. On top of that, we have this oil price fall. The first inclination of policymakers, firms and households is to go back to the boom period. And that is really very stubborn. In all our discussions, we have that mechanism. And in the political economy, in the expectations, everybody just assumes that if you have the right policies, you just get what you used to have. It doesn't work that way. You can get new sources of growth, but you cannot go back to where you were. And so what many governments are doing when they see the economy dropping is they start with fiscal stimulus. There's nothing wrong with fiscal stimulus. It's very helpful if you have a cyclical downturn. If you have a structural change, then it can push you in the wrong direction, because often that fiscal stimulus actually is spent in the construction sector, but that was just a problem, because you had grown in a way that all the growth came from the domestic sector, and especially the construction sector, because countries were receiving a lot of oil revenues, they were receiving a lot of remittances, they had easy access to international finance, and so that were all ingredients for Dutch disease. Growth was coming. If you now react to the big change in the environment, where the external revenues are no longer there, and you continue to invest in the non-tradable sector, then you're moving the economy in the wrong direction. But then, if you realize that, and you say, okay, let's try to do something else, let's adjust with the relative prices, and let's spend in a way that stimulates the tradable sector, then you also have a problem. Because then suddenly you realize that there are all kinds of binding constraints, competitiveness policies, competition policies, vested interests, that were not really harmful when all the money came in, but now suddenly is a problem. So, to frame the discussion, the way we talk about this is probably these are the 5 areas that you should start addressing, and probably in that order also. So first you have to rethink monetary policy. Just keeping a constant exchange rate vis-a-vis the dollar is untenable. And then you can do a couple of other things. You can have a completely free float and target in inflation. There's a whole discussion in our recent economic update what inflation rate you should take. There's one proposal to start targeting the oil price in local currency. That's a very interesting one. There's quite a bit of literature on that also. But then when you have done that, you create all kinds of vulnerabilities in the financial sector because of the dollarization of the financial sector. So you need a plan for that, on how to address that. Then you have to secure fiscal sustainability, which is much easier if you have done those two first steps, because your fiscal tensions are much less when you have a depreciation. And when you get the financial sector under control, the fiscal problems are much less, because a big part of the fiscal problems is the contingent liabilities that you have to bail out banks. But then this, for the political economy, is incredibly important. That you can explain that this is actually a fair burden sharing, and if some people are really hurt that are vulnerable, that you have policies in place to protect them, and that there are not certain groups that get huge profits out of all these changes and that are untouched. And you need really good communication systems also. But then ultimately it is all about this. And that is realizing that the world has moved on. And that is realizing that there is now an opportunity that wasn't there before to start creating jobs in sectors that have to compete internationally, where you always thought that, oh, that's not possible. Competing with China, just forget it. That's not possible. But now you have an opportunity. And in our economic update, we have a whole chapter on the impact of the changes in China on this region. And we actually come out with a very positive view that it creates all kinds of opportunities there. This is an exercise that we did with our general equilibrium model, just to get an idea of what all these relative price changes mean for a shift in employment over different sectors. And the example of Russia here, but we did it for many countries. And not surprisingly, you see a big decline in employment in the construction sector. And the way to solve that is start growing the tradable sectors. So you expect growth in other agriculture, that's the processed food, and in other manufacturing. And actually it's interesting when you look at the data, I have it also, but I have to stop at some moment, because there are many, many slides coming. But actually when you look at the data, then in many countries here in the region, last year you saw agricultural production going up. Farmers are now much better able to compete with imports than they used to be. And even there are opportunities to start exporting. And there are all kinds of contracts coming now with exports of food products to China. Politically sensitive in some cases also, but you see that the economy is on the move. You have to facilitate that. This is all about, so here we have it, yeah? So this is the direction of trade, because these relative price changes, not only originating here, but also originating in China itself, they would expect you to change only from 2013 to 2015. This is the share of China in the exports. It is increasing. Yeah? While the share of Russia in the exports is decreasing. Very much consistent with this whole model. And you see it for Georgia also. It was only 1% in 2013, the share of exports going to China. Only 2 years later, it is 6%. I think there's a huge opportunity there, especially when you think through all the changes in the Chinese economy that we are doing. I stop here because there's now a whole set of slides, and I will leave the presentation here, that will talk about that new economy that we're seeing emerging, the sharing economy, the role of digital development, the digital dividend. And then you see that in this region there's still a way to go to be able to benefit from it, but if you start thinking about new sources of growth, you cannot ignore it, and you cannot continue to think how it was. After that, there's a whole story of China. This is all about China, which you, and it's all written up in the economic update for the region that we're doing every 6 months, and so you can find that on the website also. But just one observation when I'm here in the School of Economics. Don't underestimate the power of very simple models and very simple econometrics. And it gives you a much better insight than just reading half of your day, the FT and the Wall Street Journal, which is also important and you should also do. But to get a deep understanding of all these changes that are happening is incredibly important. This is not just fancy theory. This is something that is really important for the real world. Thank you so much.